If you're a franchisor who has more sold but not open stores, that's not growth. That's actually a red flag. And the SBA is looking at things harder than ever, and it could put your brand's growth at tremendous risk. You know, one of the biggest challenges in the kitchen? Managing that fryer oil. It's messy, it's hot, somebody's going to spill it. And quite frankly, nobody ever actually wants to take on that responsibility, or even worse, they lie and they say they did it. Nobody wants that job. That's where Restaurant Technologies comes in. Their total oil management system takes care of everything. It's completely automated. So there's no back and forth on who does what and when, or no one's getting burnt. And there's no issue of any slip or fall because maybe you didn't clean it up entirely. They automate the entire process. They deliver it, they filter it, they pick it up, and they recycle it. No burns, no spills, no hazards. All just a safer, more efficient process and a safer restaurant. And here's the thing, there's no upfront cost. So if you want to cut down on accidents, protect your team, and keep your kitchen running smooth, just head over to rti-inc.com or just give them a call, 888-796-4997, and get started today. All right, guys, welcome back to Close Monday. Today's guest is a friend of mine and somebody who's been in almost every angle of this commercial real estate finance world. Robert Withers has been in business for over 30 years, building, scaling, and selling actually multiple mortgage companies, one of which, if I'm correct, started in your parents' den in like 1986. Is that accurate? Wow.
With their little schnauzer was my sister that sit at my feet while I was typing away on a typewriter, getting the mortgage applications out. So
you got to start somewhere. Well, since then, he's been featured on outlets like the New York Times, Wall Street Journal, CNN, NBC, and more. And he's the founder of M1 Capital Corp, where he's helping investors and business owners across the country navigate the maze, truly the maze, of commercial real estate finance. And not just a deal maker, he's also an educator, a community builder, and he teaches real estate finance for HCAR here in the Hudson Valley in Westchester County. He's the co-founder of the Breakfast Club, a group focused both on professional growth and giving back locally. But today, we're going to tap into Robert's expertise to break down these new SBA rule changes, what they mean for franchisors, franchisees, how lenders can really look at your pipeline, what you've done historically, and what you can do right now to make sure you're making the right decisions to make the brand more bankable. So, Robert, again, thanks for joining me today. Close Monday. Last minute, I asked you to help in once I saw this headline. So thanks for taking the time.
My pleasure. My honor. Honor. And thank you so much. Your friendship and your professional affiliation has always been very much appreciated by us at the company. So I thank you. And by the way, I have to say, as a former, I don't want to say owner, I never really outright owned a restaurant, but being involved in restaurants, the name of your podcast says it all. I love it. Very creative. Anybody who's been in the restaurant business knows what it means.
That's exactly right. Because everybody outside the business is like, they're like, well, that's not grammatically correct. It should be closed Mondays. And I said, well, actually where the name came from, it's very inside, is sorry, we're closed Monday. Monday.
Perfect. When I saw it, I said, oh my God, that's Kyle at his best.
Branding, right?
So
I'll take it.
Thank you for allowing me to join you today. And I know that you, as soon as the SOP 50 changes came out on June 1st, you dialed me up and said, hey, what does this mean? What are my clients? What are they looking at now? Yeah, exactly. And what I can tell you, and by the way, it's not only my experience in lending to franchises. We've done some work with certain restaurants, some Dunkin' Donuts franchisees and things of that nature. But really my real estate involvement in real estate, and when it comes to the SBA, it's back to basics. And that is, the days of creative financing and, fluff and all of that other stuff that may have worked in the past is not working today. So, SOP 50 just basically says, show me the money. Show me the money. Where is the equity? Where is where does the rubber meet the road? When is this going to start being profitable? When can we expect, debt service to start coming in for the loan that we're providing for this? And, they want to see equity, they want to see involvement. They want to see commitment. And that's just makes sense lending.
Yeah.
I cut my teeth in the mortgage industry on the residential side, and I remember going through the financial crisis. And I remember people closing on homes, Kyle, and walking away with a check. They would actually come to the closing, buy a home, and because of the way the deal was structured, they were paid all their closing costs and would wind up coming out of the closing with a check. That's
Wow.
not the way it's supposed to be.
Yeah. Something's going wrong there,
Yeah.
right? Something is wrong.
Yeah.
But I
So,
mean, Ed, I had
So,
a
so
question.
it's just back to basics, and
Yeah.
it's a strengthening. I don't want to say it's bearing down, but it's a strengthening of underwriting guidelines that have always been there.
So, as somebody who's pretty naive to the process, I mean, generally, when I have a question, I go to you. So, it's very transactional in that nature that if I need to know something, I'll ask you. And I only interact with SBA type stuff when I have a client who's like, "Oh, I'm getting an SBA loan." And I'm kind of just like, "Hey, where are you at in this process?" And I get some feedback. But what was it? I mean, to me, that's what I thought it was. I didn't think there was any sort of creativity to it. I know that they were generally kind of wanting to help small businesses get funding for their projects, but what caused this sort of buckling down? If you know, it seems like it's normal process to me.
It is. But just remember the trouble that our industry got into,
Mm,
including on the real estate side and the extension of credit in the credit markets when it comes to things like lending against a business, which is what a franchisor loan is. The bottom line is 10% is the minimum right
hmm
now. It's the floor. And you were able equity for you to bring to the table and in regards to the purchase of this franchise. Um, there were lenders, second tier SBA lenders who were getting creative and was able to do, less than 10% down. There were lenders who would be able to finance the closing costs. They were able to manipulate where that money was coming from. Could it be a gift? Could it be the bottom line? And also what that means is enhancing somebody's personal financial statement. I'm
mm,
not talking about voodoo. I'm just talking about what an how they would look at a deal and say, well, we can make the deal work this way. It's more of a stance now, to your point of this is what it is. It's 10% equity and you're better off coming with 15 or 20. And it's going to strengthen the file and your personal financial statement should look good. And your projections are, by the way, then considered. Where before the projections were maybe something that they would really hang their hat on, it's now more show me the money, show me where you have money and liquidity, and then we'll consider your projections. And it's just makes sense lending.
yeah, because I mean, I guess it's so for anybody who's not super familiar. I guess what's getting caught up here are these sold but not open stores. So you have this franchise sales team that's selling a bunch of different markets. And I guess the SBA was looking at that like, okay, wow, you have some real growth here. You have people interested. But then for whatever reason, these stores weren't opening. So there's really no value to those businesses. The businesses don't exist, right? They only exist on paper. So these sold but not open lists for franchisors are going to be a problem, it seems like.
Absolutely. Kyle, you've been in this industry a long time and you know what it takes to open up a restaurant or any sort of retail establishment. You know what it takes. And, a signed agreement is all that. It's an agreement to start a business. And that's not where it starts. It starts with the business plan being able, if somebody's showing up to the table with 80 or 85%,
Mm.
hopefully, capital to start this business and fund this business. Boy, let me tell you something. If I was the person who was lending that money, and a lot of times I'm bringing the lender to say, I would want to know that it makes sense. I would want to know that all your ducks are in order. And I want to know damn well when you're going to be starting because nothing happens until there's cash coming in the door. And you and I both know it. It's not on day one. All right. So yeah, SNO is not a great, I think, litmus test in regards to the viability of a business or franchisee involvement in a business, because it's tough to say what location, how long is it going to take for you, what's involved in getting that location open. There's just so many variables to it.
I'm trying to think of this from like a devil's advocate perspective. So I'm like a franchisor, right? And I got a guy who's busting his ass selling franchises, and we got a bunch of markets. And yeah, I have a ton of sold but not open stores, but the real estate market is impossible. It's tough for me to find to find places. And quite frankly, you can make the argument too that's on the financial side of the franchisees rather, who are not really qualified to be tenants in some of these spaces.
But
Different show. But
dovetail into my next subject.
so then, so how can they make the case almost like, hey, it's not my fault. Like there's interest. There's no product on the other end to make it happen. Is that argument ever
So you're
valid?
talking about there's not a location that's open?
Like
Or
they've got 100 franchisees who want to open. They're now having difficulty getting franchisees approved, but they're like, hey, this isn't our fault. There's not the product on the market to put them in. So yeah, in this case, in my mind, again, devil's advocate, both sides seem right. Like, hey, I'm not going to lend to you. The stores aren't open, but they're not open because there's no real estate market. So how do you go from there?
you don't sign an agreement until you've located a location. You've selected a location. That and I know that may not bode well for the industry as a whole, because obviously in any situation we're in sales like this, we want to sign up as many people as possible, but an agreement that's signed and incurring expenses with no location to be able to open it in, to a lender, that doesn't mean growth, Kyle.
Yeah.
That means
No.
risk.
Oh yeah, right.
That doesn't mean growth. Just because you have 10 locations that you're signed up for, but you don't have a place to be able to put them in, that doesn't mean growth. That means risk.
Yeah.
So, you know, it's not. And to your point before, and why I wanted to mention is, you know, it's so important, and I'm going to stress this later on in our discussion, to have somebody look at your plan, your business plan. And I'm talking about a third party, whether or not it's your CPA, your attorney, if they're versed in these things, or somebody like myself who's an expert on SBA lending. It's so important for them to lay it all out and say, this is what we want to do. This is where we want to do it. And this is how we want to go about doing it. So many times we're an afterthought. The financing is an afterthought.
Yeah.
And financing can't be an afterthought. The financing, that's how the major commercial real estate markets work.
Oh yeah.
A developer who wants to put up an office tower in Manhattan doesn't look first at whether or not he feels that he can lease out the building, or what it's, obviously the numbers come into play, but what it's going to look like, what it's going to get designed like, I want to know he's going to get the financing. What's the capital stack look like?
Yeah.
What does the debt look like? What is the preferred equity? What is his partners who are coming to the table with money? What does that look like? Because if it's not financeable, it ain't happening, Kyle.
I know. I've even heard I mean, it gets so crazy. I've heard people, they get the drawings done, they get everything done, and they look like they're ready to market the place. The existing product is not out of the existing building is still there. The new product's not out of the ground, and they're like, well, now we just have to go find the money for it. They sometimes do it in reverse.
I never understood that.
Yeah.
And really, it's interesting because it's not the more sophisticated borrowers. The more sophisticated borrowers start with a guy like me, a company like ours, prior to, and they test the debt markets. It's the newbie who goes out there, cuts the deals, talking to the seller, has a price. Look, we got to close it in August. All of this other stuff going on. Then all of a sudden, it's like, you're not even financeable. The deal doesn't make any sense.
Right. My God.
It's a lot of wasted time, unfortunately, and they pay for attorney's fees, and they pay for actual fees, and they waste your time, and they waste my time, and it's not a good thing. So
I'm sure you have seen it all.
Yeah.
When it comes to that. Yeah, those guys are they're rolling the dice. Yeah, I know. right? Because there's a thing like you like it's like I wanna I wanna be able to help because the easy stuff kind of gets boring, right? I would imagine. Like you want to find something you can kind of see if you can provide value and navigate.
Yeah, yeah. I'm going to tell you a story. I cut my teeth in the residential side of business, as I said before. And right after the financial crisis, I had taken some time off. I had actually sold off the sales platform of my third mortgage company. And I was sitting tight for a couple of years. And my daughter was young. And we walked into Walmart. She wanted to go to Walmart. I mean, she'd never been to Walmart. So she wanted to go to Walmart. It was right here in White Plains. So we walked across the street, went to Walmart. And when I walked up, I saw a banner and said, "Get your home mortgage here." And I looked at the banner and I said, "What? You can get a mortgage at Walmart?" And at that moment, Kyle, at that moment, I said to myself, "I'm out."
Yeah,
I knew that when I was going to return after things dust settled, it would be doing more business financing and commercial real estate financing. And I'll tell you why, because you can be more creative.
right.
People need you more. My daughter told me she was gonna get a mortgage on Rocket. She was gonna go to a she was gonna go
Oh
to
boy.
apply for a I said, "No, you're not. Don't you dare do that, okay? You're gonna speak to an individual who's gonna guide you through the process the
Yeah,
right."
those are the days for sure.
And unfortunately, we live in a time right now where you can apply for a SBA loan online and supposedly get $250,000 wired into your account next week, next day. No.
Yeah. Yeah. And if anybody wants to find out if that's true, try registering your business online and see how many texts, emails, phone calls you get from anybody trying to provide some kind of funding immediately, like that type of stuff. Doesn't work that way. So yeah, that's clear. So there are a couple things in here, and I know maybe they're a little bit granular on the details, but they mention in this new rollout that item 7, which are like estimated investments stuff, item 7, item 20. I mean, did we already cover that? Is there anything that we need to discuss there in terms of specifics that these guys need to be aware of, or is that more of a kind of like next?
Item 20 is really the franchisors report card. Lenders pay a lot of attention to it. They really pay a lot of attention to it. Healthy brands, they open units, right? I
Yeah.
mean, you know that. I mean,
Yep.
when you're a brand that's well known and it's healthy, it'll open. Weak brands, or let's say risky brands, come with the risk. So that's huge. I think item 20 is looked at as a report card. And I think that, by lenders, and I think it's a very important thing. So it's not something to be discarded. I'm not saying that, an experienced investor in one of these franchises should stay away from a less known franchise, but you really got to know what you're doing. And you get, you may depend less on on the financing. As far as item 7, it's a fairy tale. I have to be honest with you. The financing will be a nightmare with
Really?
item 7. Yeah, it's well, undercapitalization kills more deals than bad locations.
Hmm.
You've got to be capitalized well.
Absolutely.
You
Yep.
you've got to show where you have the wherewithal to bring this franchise into existence. And should things not go well, I have not a franchise, but I have a client right now who bought a building. I won't talk about the town or anything like that because I don't
Hmm.
want to, but bought a building, and it was always their dream to have a restaurant. They were never in the restaurant business. But it was always their
Mm.
dream to have a restaurant. So they bought a mixed use property with a couple of units and a restaurant location. And that restaurant took way longer than they thought to open up.
Mm.
And they needed to borrow all sorts of money to make it happen. Well, they over improved the property. They
Yes.
and they ran into a lot of trouble. They ran into a lot of trouble. So the capitalization is key. And I think
Mm.
that is, the investment costs are very highly scrutinized.
Yeah. I mean, I think, for me, immediately when you start talking about that, these like negotiations become more and more important, right? Generally, people will kind of almost scoff at like the rent commencement date on an LOI. Like, oh, we need 180 days. You might need more. You might need more. Where are you getting that number from? And they'll kind of bob and weave from 150 to 240, settle on something around 180. But because the reality is there are plenty of stores that I know that have opened and are paying rent and are not open. That's a horrific situation,
And
right?
the second most nervous person in that situation is the lender.
Yeah. Yeah,
You know,
right.
and
Exactly.
you don't want to be in that situation. So capitalization is
So for franchisors, we'll go through this quickly before we get to the real estate part, which I know is critical here. If I'm a franchisor, I got my team, they're bringing on franchisees. If you were in their seat, what are you telling them? What are you telling that sales department team? Like, hey, effective now, this is what I expect, and I don't want any more XYZ. What does that conversation sound like?
it's important. When I teach my course at Hagar,
Mhm.
I talk to the upcoming new real estate brokers and salespeople about putting together their team, Kyle. They're basically they're in business for themselves. And whether or not they work for a company or whatever, it's their brand, it's their entity, it's their company. And that's the way that they should look at it. And they need a team. They need an attorney, they need a Kyle, they need a Robert, they need a
Yeah.
CPA, and they need the people on their team that can really help them put that business take that business to the next level. What I would tell them is it's extremely important that you bring a client in who's interested in doing a deal and have them sit down with the financier first. First, not the
Mhm.
attorney, not the CPA.
Yeah.
You know, it should really it should be you as the broker in between that's bringing the asset or the product to the table, buyer and the team member who's working with you,
Yeah.
and meaning working for for the company that's selling the franchise. It's absolutely essential, and have that. And it sounds self-serving, right? Because I want to meet with them first, but it's
Right.
not.
No.
It really, because what I can do by just really at looking at their personal financial statement and trying to figure out and looking at their business plan, and it could be a 2-page business plan. Really, it doesn't have to be, like you're starting Amazon all over again. No, it's a 2-page business plan, and you're very quickly, this is not going to cut it, or it will cut it, or this is what needs to happen so that it's got a better chance of cutting it.
Yeah.
And that's what I would tell them. Put your team together, get your people that you trust, use them time and time again. Make sure you have an attorney that you work with. Make sure that your Kyle is working with you. And if this is where you're going to focus your business, boy, let me tell you something. That lender has got to be at the top. And again, this is going to sound, but it's better off to get it to a third party prior to getting it to the lending. Not a lot of people realize that, brokers like myself, broker in debt financing for both businesses and commercial real estate. Our client is not the bank. We're not representing the bank. We're representing the person who's borrowing the money. So I'm going to help them structure that deal to make sure that it's best portrayed or best presented to the lender. It's money well spent, and it very well can decide whether or not it's successful or not.
Yeah. It's I always use the analogy of, if I tore my rotator cuff, I don't want to go to a general practitioner, right? I don't want to go to the clinic. I want to go to the guy or the gal that's done 10,000 shoulder surgeries. They can look at me and diagnose or tell me where to go, where the treatment is, or what the best course of action is from here. I want to know that they know what they're talking about. I need a specialist. I need somebody who can tell me yes or no and quickly, right?
Yes.
That's always
Yes.
the analogy I make for financing commercial real estate. I call you. Anybody else for restaurant real estate? I hope they call me. In that regard, I think this is really kind of tantamount to the whole situation. Is you need somebody like you to advise them, say, hey, this is what they're going to expect, and you're not there yet, or hey, you're in a great place. That seems to make the most sense. I know for franchisors, it's going to come down to like, well, we don't have the time to do all that, but do you have the time on the other side? You know what I mean? I think it feels better. It just feels better if they are bringing sales through the door. They have some money coming in, at least on the deposit side. but it's a risky game. It sounds like.
I have a client who I work with on the commercial real estate side, a big player. And he also has a business where he owns a bunch of top notch, well known franchises. Okay.
Mm,
I'm talking like 400 locations. All right. And he calls me to ask about what's going on in the lending world. And this is a guy who obviously is very attuned to what's going on, not only on this side, but also on the commercial real estate side. But he wants
mm,
to know what's going to fly, what's going to make it by an underwriter. I work it backwards. The projections are the third thing. Where's the money coming from? How did it get there? Do you
mm.
have enough capital to sustain yourself? God forbid you run into problems. And then, okay, let's look at your projections.
Yeah. I mean, yeah, exactly.
Throwing spaghetti up against the wall ain't going to work anymore, Kyle.
No. Wow. All right. So now let's pivot from that. I know we have a little bit of time left here, and I want to focus on the real estate side of
Yeah.
this because you and I deal mainly on that side, less on the straight business funding. But where I sit on this side, undercapitalized deals are going to collapse, like we spoke about, right? We just mentioned getting involved early on in the process and getting aligned. But is there anything else that on the real estate side that you're seeing right now in the market that should be top of mind for anybody looking to invest in a property? Maybe we haven't discussed, or maybe that's sort of new and just in front of you right now.
Very important that you find out that title is clear. That title is clear. Very important that you find out that there are no hidden issues. I was just involved in a deal earlier this year where a restaurant was being sold to a gentleman who's going to and his wife who were going to continue the operation of a well-known restaurant here in Westchester.
Mm-hmm.
And unfortunately, unbeknownst to themselves, there was a retaining wall issue in the back, and there were permits that were never closed, and the wall was never fixed, and it was not something he felt comfortable moving forward with. Now we had gotten him approved; it was all done, we were ready to go. It was a relatively small deal. I mean, not to say that $1.4 million is small, but it wasn't like one of these massive um, undergoings where he wasn't out of his realm. He had a couple of other restaurants, and he was comfortable with these numbers. But he wasn't going to buy a restaurant where, God forbid, one day he would walk out and the wall came down and destroyed half of his restaurant and all the cars parked in the parking lot. So he wasn't willing to take that chance. And by very easily finding out whether or not there was any open permits on it's a $350 cost to find out if, by ordering a title report,
Right,
you
right.
know, especially an older restaurant where you would think, okay, and they've owned it for 30 years. You would think maybe they didn't do that often. It didn't trade recently. And the other thing is environmental issues.
Hmm.
Environmental is huge.
Yeah.
I need to
I
tell
just
you.
got into it with that. I
Yeah.
learned my lesson on that recently. Well, actually, I got close to the edge of going too far, and yeah, it was a big deal.
We, we,
Dry cleaner situation.
well, those are always a problem. But
Yeah, yeah.
let's face it. We just closed on a client who opened up their second location out in the Hamptons. They have a very well-known market in East Hampton, and then opened up their second location in Southampton.
Hmm.
And there was in Southampton, on the Southampton location, they bought it, but they never. There was a pipe sticking out of the wall of the building going into the ground, and nobody
Hmm.
questioned. So finally, upon the appraisal, what's this pipe? Where does this pipe go? It goes to a tank. Oh, was the tanks under the ground? Yes, the tanks under the ground. Oh my goodness. So then, now we were going to do an environmental anyway, but we found out that there was a certain amount of remediation that needed to be done. And you know what? That deal that we would have easily probably closed in 75 days took a little less than 6 months. And it was all because of the remediation that needed to be done. And it was so easily handled. You make it the seller's issue, because listen, he has to deliver not only clean title, but also a property free of any environmental hazards. You don't negotiate this after the fact. You do it before.
And that's what happened to me. Just quickly, we a property here that you would know if I told you the address. We got down to it. We're negotiating, and they never mentioned what was on the site previously, which was a dry cleaner. And for those of you that don't know, if you ever come across a potential dry cleaning site, just know that back in the day, and you could probably attest to this, mechanics and dry cleaners would dump their cleaning fluids basically into the ground. Right? They were just dumping it into the dirt, thinking they were just getting rid of it, putting in new stuff. Turns out that's really bad for everybody. So we got down to making an offer back and forth on a number, and they were like, oh, by the way, this property needs about $600,000 in remediation. Here's the estimate. I'm talking about 3 weeks of back and forth on an LOI, and this never got brought up, and it was dated. Like, it didn't just come up during that process. So definitely can be a major
that's negotiating in bed. That's negotiating in faith, because
Correct.
you know what? Let's face it. Everybody knew that was, except for the buyers, and maybe you too. No, definitely you too. That was there.
Yeah.
His attorney knew that it was there. He knew that it was there. You know, so that just, these are the questions you have to ask up front when you're in this world.
Right. And at that price level, this is almost a $5 million property. They don't think it's going to come up. Like, it's just such a weird thing. But yeah, you're right. They're negotiating in bad faith.
Yeah.
So I guess in closing, we can say that SBA rules are back to basics, right? Equity underwriting. You got to get your name in that directory, which I don't think we spoke about. The SBA has a directory of franchises that they feel are more buttoned up. That seems to be a priority. Sold, not open.
Probably name them off the top of your head, Kyle. I mean,
yeah, I know. Yeah, you're right. I know. Just driving by them, I know which ones they are.
Exactly.
For franchisors, sold, not open, red flags. They are not a good thing anymore. They don't indicate growth. Item 7, item 20. It's going to really tell you guys everything. But at the end of the day, it's about deals that are done right and doors are open. And you only get that by dealing with somebody like Robert, who can help you navigate this process. You guys are looking at things the wrong way. I know it feels good, but you got to get these doors open. That's what matters. And that's what's impressive. And once you do, that's when you can start really getting lenders knocking your door down, quite frankly. So, Robert, tell everybody where they can get a hold of you. What's the best way to learn from you? The floor is yours.
Absolutely. Thank you so much. We're located in White Plains at 50 Main Street. The name of the company is M1 Capital Corp. My cell phone number is 914-490-8623. That's 914-490-8623. The website, which has a lot of information in regards to SBA financing, is mortgage, the number one, the numeric one.com. That's mortgage, the number one.com. And you can reach me at info@mortgageone.com.
That's it.
That's it.
And to be clear, you work across the country. Does not have to be here in New York. You can work anywhere across the country.
That was another impetus for me to be able to go into this world of commercial and business financing, is it wasn't state licensed. So, you know, but I'm a really more of a Midwest, I don't want to say East Coast to like Chicago. You know, I do business in Florida, Chicago, you know, some places that I don't really dip my toe into California, because I have to be true to my client, and they're probably better off dealing with a Robert out in California, because they know the areas better and they know the lenders better. But East Coast out a little bit, I'm your guy.
All right. So 2/3 of the country, he's got you covered. Robert, thank you for the time. I appreciate it. I'm sure I'll be talking to you about something I need help with soon.
And we've got our Feeding Westchester event coming up. So
that's right. Absolutely. So I'll see you there.
All right. Sounds good.
Appreciate it.
Thank you, Kyle.